Gold soaring to $4,000. Is it inevitable or a dangerous fantasy? Is this rally truly built on solid fundamentals, or is it just a house of cards built on hype and stories? And when nearly every expert is bullish, is that a market consensus or the most dangerous contrarian indicator? Hey everyone, welcome to the debate. We have only one goal here: to cut through all the market noise, challenge the prevailing narratives, and help you find the clearest path forward in this confusing market. Without further ado, let's get started.
Ladies and gentlemen, let's talk about gold reaching $4,000. With gold already trading above $3,300 per ounce, we're not crossing into fantasy. We're talking about the last stretch of a journey already in progress. Here's why I strongly believe gold is heading toward $4,000. First, central banks are leading the charge. Around the world, central banks are buying gold at historic levels as they diversify away from the US dollar and seek stability in turbulent times. When the institutions managing national wealth show this kind of commitment to gold, they create a solid foundation under prices. Second, economic fundamentals are working in gold's favor. Interest rates are widely expected to come down, with the Federal Reserve likely to cut several times over the next year. Lower rates make traditional savings less attractive and support higher gold prices. At the same time, inflation remains a concern, so gold stands out as the proven protection against currencies losing value. Third, investment demand is surging, backed by some of the world's smartest investors. In just the first half of 2025, investors poured $38 billion into gold ETFs, the largest inflow in years. And it's not just everyday investors getting on board. Legendary investor Ray Dalio recently reaffirmed his positive outlook on gold, saying it remains an essential part of a balanced portfolio, especially in today's uncertain environment. When influential experts like Dalio emphasize gold's importance, it boosts confidence and accelerates mainstream demand. Major financial institutions agree. J.P. Morgan, Goldman Sachs, and others now forecast gold rising to or beyond $4,000 within the next year or two, grounded in these real-world forces. So, in summary, central banks are buying, the economic backdrop supports higher prices, and investment demand is being fueled by both broad participation and endorsement from respected figures like Ray Dalio. The $4,000 target isn't a stretch, it's the logical next step. Thank you.
Ladies and gentlemen, my opponent paints an optimistic picture, but let me present the hard facts. Gold at $4,000 isn't just unlikely. The market fundamentals are showing clear signs that this rally has run its course. While gold has indeed had an impressive run, reaching $4,000 requires another 20% gain from current levels of $3,330. And the underlying drivers simply don't support this trajectory. First, let's examine what the current data actually tells us. Central bank purchases, which my opponent cites as a key driver, are already showing signs of deceleration. While central banks did buy aggressively, purchasing over 1,000 tons for 3 consecutive years, the pace is slowing. Central bank purchases in 2025 are expected to fall to around 1,000 tons, down 8% from last year's record high. Even more telling, China, the biggest buyer, has shown signs of reducing its accumulation pace. When the largest institutional buyers start stepping back, that's not bullish, that's a red flag. The ETF flows that supposedly demonstrate strong investment demand tell a different story when you examine them closely. While gold ETFs did see $38 billion in inflows during the first half of 2025, these came primarily during the first quarter when trade tensions were at their peak. More recent data shows that gold ETFs experienced net outflows of $1.8 billion in May 2025, marking the end of a 5-month run of inflows. This suggests that investor enthusiasm is already waning as geopolitical fears subside. Second, the fundamental drivers are weakening before our eyes. The interest rate environment isn't as gold-friendly as claimed. Real interest rates, nominal rates minus inflation, remain elevated, creating a significant opportunity cost for holding non-yielding assets like gold. The Federal Reserve is holding rates at 4.25 to 4.50%, and despite some dovish talk, they're unlikely to make dramatic cuts that would significantly lower real yields. Third, let's talk about the most powerful force in any market: basic supply and demand. At today's high prices, gold mining is incredibly profitable. The gap between what it costs to get gold out of the ground and its selling price is wider than ever, meaning miners are making a fortune. This gives them every incentive to produce as much gold as they possibly can, and that's exactly what's happening. Global gold production is hitting all-time highs. When you have a flood of new supply hitting the market, basic economics tells you that doesn't push prices higher. It creates powerful pressure pushing them down. Fourth, we're seeing classic signs of demand destruction in price-sensitive sectors. Jewelry demand, which represents about 50% of total gold consumption, is collapsing under the weight of high prices. Chinese jewelry demand, the world's largest market, fell 26% in the first half of 2025, while global jewelry demand reached its lowest level since COVID-19 disrupted markets in 2020. This pattern is consistent across major consuming nations, where high prices are destroying consumer demand. To put it simply, the story for gold is changing. The initial surge of buying is over. The economic winds are no longer at its back, and the fundamental balance of supply and demand is tilting against it. My opponent's $4,000 dream ignores this new reality. Markets don't move in straight lines forever, and gold's incredible run is meeting the simple, unassailable force of economic gravity. Thank you.
Thank you. My opponent has focused on a single month of data to suggest investor interest in gold is fading. This is like looking at one frame of a movie and trying to guess the ending. Let's look at the complete picture. First, let's address those ETF flows. My opponent correctly pointed out that investors took some profits in May after a huge rally. But what happened immediately after that? The latest data from the World Gold Council shows that in June alone, inflows came roaring back, with investors pouring $7.6 billion into gold ETFs globally. This wasn't a small rebound. It was a powerful statement that smart money is buying the dips and getting positioned for the next move higher. Second, my opponent completely ignores the biggest buyers in the market, central banks. These are not speculators. A recent World Gold Council survey revealed that a record high of 43% of central banks plan to increase their gold reserves over the next 12 months. They aren't fazed by short-term data points. They are making a long-term strategic shift for one simple reason: to protect their nation's wealth from geopolitical risk and the declining value of other reserve currencies. This creates a permanent and growing source of demand that underpins the entire market. Finally, let's talk about the world we live in right now. Stock markets are at all-time highs, and government debt is soaring. Many analysts are calling this the everything bubble. In an environment where traditional safe haven assets like government bonds are looking increasingly risky, where does smart money turn for genuine safety? It turns to gold. Gold is becoming the ultimate hedge, not just against inflation, but against systemic risk itself. So, when you step back, the conclusion is clear. The short-term investor pause is over. The world's largest institutions are buying with both hands, and gold's role as the ultimate safe asset has never been more critical. The path to $4,000 is not only intact, it is getting clearer by the day. Thank you.
Thank you. My opponent just made a very emotional appeal, painting a picture of an everything bubble and positioning gold as the only safe lifeboat in a stormy sea. It's a compelling story, but it's a myth. Let's talk about what really happens when financial panic hits. In a true crisis, people don't just sell their stocks. They sell everything to get their hands on the one thing they need most: cash. We saw this in the 2008 financial crisis. We saw it again in the March 2020 crash. In the initial panic, gold didn't soar. It fell right alongside the stock market as investors liquidated everything they could. Gold is not the immediate shield my opponent claims at Island. In a real storm, even the lifeboats get sold for cash. Second, my opponent has completely ignored the fundamental problem I raised, which is the massive disconnect between paper prices and the real world. Let's call it the Wall Street versus Main Street problem. Wall Street traders can bid up paper gold contracts, but Main Street, the people who actually buy physical gold for jewelry and electronics, making up half of all demand, are walking away. Demand in China and India has collapsed because prices are too high. At the same time, miners are pulling record amounts of gold out of the ground because it's so profitable. So let me ask you a simple question based on basic economics. If your biggest customers are refusing to buy while your supply is hitting all-time highs, where do you think prices are going to go? They don't go up. So don't be swayed by fear. Look at the facts. The safe haven story has holes in it. The physical market is broken and supply is flooding the system. The question isn't whether gold can reach $4,000. The real question is how far it could fall when this speculative fever finally breaks. Thank you.
Thank you. My opponent just told you that in a crisis, people sell everything for cash. That's exactly my point, and that's exactly why gold is heading to $4,000. Think about it. When people lose faith in everything else, when stocks crash, when currencies weaken, when governments pile on debt, where do they eventually turn? They turn to the one asset that's been trusted for 5,000 years, gold. Yes, there might be brief moments of panic selling, but what happens next? Smart money floods back into gold. That's why we saw those massive $7.6 billion inflows in June after the May dip my opponent mentioned. That's not weakness, that's resilience. And here's what my opponent can't argue against. Central banks don't panic sell. They're methodically, deliberately building their gold reserves. The latest World Gold Council survey shows that 43% of central banks plan to increase their gold holdings, a new record high. When the world's most powerful financial institutions are buying gold at a record pace, that creates an unshakable foundation under prices that no short-term selling can break. The math is simple. We're already over $3,300. We need just a 20% move to hit $4,000. With central banks buying at record levels, interest rates falling, and investors like Ray Dalio backing gold as essential portfolio protection, that final push isn't a dream, it's arithmetic. My opponent wants you to focus on fear. I want you to focus on the facts. The facts say gold has momentum, institutional support, and economic fundamentals all pointing in one direction, up. $4,000 isn't the ceiling, it's just the next milestone on gold's journey. Thank you.
Ladies and gentlemen, my opponent has presented you with a compelling story fueled by fear and the idea that gold is the only safe place left. But a good story doesn't change economic reality. Let's boil this entire debate down to one simple, undeniable truth. For any price to go up, you need more buyers than sellers, and more demand than supply. What have we learned today? We've learned that at these high prices, supply is flooding the market. Miners are pulling record amounts of gold from the ground because it's incredibly profitable. At the same time, we've learned that real-world demand is collapsing. The jewelry industry, which makes up half of all gold demand, has ground to a halt. Everyday consumers are saying, it's too expensive. And finally, the investment wave my opponent talked about is already starting to recede, with money beginning to flow out of gold funds. So you are left with a very clear choice. Do you believe in a speculative story that ignores the fundamentals? Or do you believe in the simple, powerful law of supply and demand? History has shown us that bubbles always pop. And with rising supply and falling demand, the dream of $4,000 gold is just that, a dream, disconnected from reality. Thank you.
All right, over to you, the judges. What do you all think? I'm looking forward to seeing your votes and thoughts in the comments section. We love hearing what you have to say, and I believe every perspective brings something valuable to the table. Also, I've done my best to fact-check the information you've just heard, and you can find the relevant links in the description box below. Before you go, don't forget to hit that like button and subscribe. Your support means the world to us. We'll see you next time. Bye-bye.